All right, guys, let's go with the next problem. In the last session, illustration 9 was the last one that we have solved, correct? So we'll go to illustration 10. So this is again based on equity settled, but it is share-based payment, okay? Marathon Incorporation issued 150 share options to each of its 1000 employees subject to the service condition of 3 years, okay? How many share options, Nana? 150. To each of its 1000 employees, per employee 150 share options subject to the service conditions. Service condition is 3 years. Okay, what else? Fair value of the option given was calculated at 129. Okay, is this on the grant date? Right. Below are the details and activities related to SBP plan. What is that? Year 1, 35 employees left. So actually they have left because you are standing at the end of year 1. And further 60 employees are expected to leave. That is your expectation at the end of year 1. Share options repriced. Okay. As market value of shares has fallen. As the fair value fell to how much? 50. So this is modification. Okay. Based on modification. After the repricing, they are now worth 80. Okay. Hence, expense is expected to increase by 30. Okay. Year 2, 30 employees left. Okay, actually 30 employees left. And on year 2 ending, standing at the end of year 2, you're expecting that 36 employees will leave in year 3. Year 3, actually 39 employees left. Okay. How the modification or repricing will be accounted? That is a question. Right, pretty simple. Let's go to our power notes. Okay. Here we have modification, correct? So first of all, the first step when you're about to do modification is that what, Nana, whether it is favorable to employee or unfavorable to employee. When it is unfavorable to the employee, obviously what you'll be doing, you'll not be doing any sort of accounting, you'll ignore it, right? So accounting for ESOP has to be done as if no such modification has taken place. But if it is favorable to employee, what you'll be doing? Exactly. Modification will be treated as separate plan and incremental fair value of the option will be recognized as an expense over the remaining vesting period from the modification date to the remaining vesting period on SLM basis. For example, here initially the fair value was 30. After modification it was 90. So which means what is the incremental fair value? 60. This 60 will be recognized for the remaining vesting period. That is this period and this period, 30, 30. And the original plan from first year your in this example it was 40, 40, you're debiting the P&L, right? With 40, 40, you're recognizing this option expense. That will continue. The original plan will continue. In addition to that, you'll be getting this additional plan because of this. Okay, apart from this original option expense recognition, should continue, which is 40, 40. That will continue. You got the point? So which means once you do modification, this is the first rule. Favorable or unfavorable, right? Once that is clarified, once it is favorable, then what you will do? Find out the incremental fair value. To the extent of incremental fair value or incremental benefit, you will recognize it on SLM basis for the remaining vesting period and the original plan will continue as it is. This is the concept which we have seen. Correct? Right. Having said that, now let's come back and read this question. I'll just give you 30 seconds. After that, we'll start solving. You got 30 seconds. Done with the reading, Nana? Chalo, let's finish it off. I've already revised you the concept as well, so it should be easy for you to solve. This is illustration 11. You guys ready? Okay. We'll start with the first heading. So at the end of year 1. Now what we'll be doing, Nana? As usual, option expenditure will recognize. Okay. Option expenditure at the end of year 1. Which is how much? 100 employees totally you've got. Number of employees at the end of the vesting period only, na? Right. Minus How much? How many employees you need to reduce? So 35 employees left. So obviously minus 35 minus 60, because at the end of the first year, standing at the end of the first year, you're expecting that in future years 60 also will leave. So minus 35 minus 60. Clear? Minus 35 minus 60. Number of employees into number of options per employee 150. It is given in the first line of the question. Into fair value on the grant date 129. That is also given at the beginning of the question. I think it is second line. So every time I can't go back and then I can show you here. You should remember second line 129. Okay. This 150 share options is given in the first line itself. Moving on. Into vesting period completed, first vesting period divided by total vesting period 3 minus option expenditure recognized already in the previous year 0, which is equal to, can you guys help me out with the number? Right, 58,37,250. Done. Now if you can see the question, modification happened at the end of first year. Sir, how can you say it is at the end of first year? Sir, very simple, Anna. Year 1, these many employees left. When do you know that these many employees have left? Only when you come to year end. So therefore these many employees are left means, I mean they have left the company means you are already at the year end. And at the year end, what is happening? Share options are getting repriced, and fair value fell to 50. And after the repricing, they are now 80, which means you have modified it. The fair value from 50, it has got increased to 80. Therefore, increase in fair value is 30, which is the modification. If fair value increases by 30, it is favorable to the employee. If it is favorable to the employee, should we account it? Yes. Are you able to understand? Because expenditure also will be increasing for the company. So therefore, we need to recognize that additional expenditure as a company. How much benefit increases for employee, that much expenditure increases for the company. Clear? Right. That is done. So which means at the end of first year only we have the modification. Let's do that. So modification happened. I'm writing happened in shortcut, okay? At the end of year 1. So what is the incremental or additional benefit because of that modification? It is favorable to the employee. If it is unfavorable to the employee, we will ignore it. Okay. New fair value is 50. Old fair value was, sorry, new fair value is 80. Old fair value is 50. Therefore, the incremental benefit is 30 per option. Okay. And should be recognized. What is the concept? It should be recognized as expense. On which basis? On SLM basis over remaining vesting period. In this case, what is the remaining vesting period? You are at the year 1 end. So which means 2 years. Year 2 end and year 3 end. Correct? On SLM basis, obviously. This is what we have studied in the concept, right? Copy paste. That's all. What we have learned in the concept, exactly we are writing the same. Okay, now come to year 2. At the end of year 2. Nana, understand one thing, Nana. We have just now I have also revised you the concept. The original plan will continue as it is. What is the original plan? This one. Ye to continue hoga as it is. In addition to that, this also will come. You understand the point? Right. So let's start with the original plan. Means what? Whatever the original plan that you have got here, ye to continue hoga. This will continue. So don't get confused. Okay. As it is, the original plan will continue. So what will be the number over here? Option expense is equal to again number of employees. That headache is there. Easy only. By this time you guys should have got that expertise. You are at the end of year 2, right? Year 1, how many employees have it? Take the gross value first, 1000 minus year 1. Actually 35 employees have left. That you should take because you are at the end of year 2. So you know the actual employees left in year 1 and actual employees left in year 2. So minus 35 minus 30, and because you are at the year 2 end, you should expect how many employees are going to be leaving the company in year 3, which is 36, right? So therefore, what's your number? 1000 minus 35 minus 30 minus 36. Clear? into number of options 150 into fair value on the grant date 129 into vesting period completed 2 divided by total vesting period 3 minus option expense recognized previous year 58,37,250. That's it. Can anybody give me the number? How much Tana? 57 lakh 59,850. Okay, thank you. Now, what about the next one? We also need to recognize incremental option expense. What is this? Due to modification. Correct? You'll do this separately on straight SLM basis, right? And original plan also will continue as it is. That is the concept that we have learned. How much is incremental? Now here also the formula remains the same. Number of employees at the end of the vesting period, which is 1000 minus 35 minus 30 minus 36. It is the same company, na? So as per original plan, how many employees you are expecting? How many employees have left in year 1, year 2, and how many employees are expected to leave in year 3? Same will come here as well. Okay, because it's the same company. Into number of options same 150, same company, same employees, same plan. Into fair value of the option will change because now we need to take incremental fair value into vesting period completed. Now only the modification has come at the end of year 1, which means year 2 is the first year for modification. So first year completed because now you are at year 2 ending, which means 1 year is completed for modification divided by what is the total vesting period for modification? 2 years. Clear? For original plan, what is the total vesting period? 3 years. Because your modification or repricing happened at the end of year 1, therefore year 2 and year 3 are the remaining years for you, right? So the total vesting period is 2 years only for modification. And second year completed, which means 1 year completed. Minus. Did you recognize any expenditure in the previous year for modification? No. Therefore, minus 0. For modification, I did not do anything because this is my first year. Okay. How much is the number? Help me out. Calculate and tell me. Okay, 20 lakhs, 22,750. Array, only to communicate only I have created a Telegram group for you guys, right? You participate. How much active you are, that much I'll also be active over here. Now you are giving me answers. Make it fast. Don't be lazy in using Calci, okay? My examination is done. I've passed all the exams in my life. I've passed CA, I've passed CS, I've done 2 PGs in economics. Okay. I've done civils also. I've written multiple times. All the examinations I've written in my life. So, mera life ho gaya. So now nobody is going to check me whether I am using Calci or not. Is that clear? You guys are going to write the exam. Okay? Alright. Oh, yes, sir. Yes. Okay. Chalo. Alright. So what is the total expenditure that you have to recognize in the second year? Original plan plus incremental plan due to modification. So which is how much? Give me the number. 57 lakh 59,850 plus 20 lakh 22,750. Okay. 77 lakh 82,600. Good. Keep on participating like that. Now we are done with second year. Now at the end of year 3. Alright, Nana. Now tell me. Original plan will continue. So option expense in year 3 is equal to. Now again, number of employees, we have to take care of it. So what about number of employees? Gross figure is 1000 minus 35 left in first year minus 30 left in second year and 39 left in third year. Because you are at the end of the vesting period, you are at the end of the third year, you know what the actuals are. First year actuals, you know, second year actuals, you know, third year actuals, you know. Easy peasy. Right? In that case, it will be 1000 minus first year actuals minus second year actuals minus third year actuals into number of options is 150 into fair value on the grant date for original plan is 129 into vesting period completed is 3 divided by total vesting period is 3 minus option expenditure recognized in the previous years. 58 lakh 37 250. That is first year. Second year 57 lakh 59 850. Right. Calculate this and give me the number, Ray. Come on, make it fast. How much? Okay. 57 lakh 40,500. Is that it? Others, confirm me the answer. All right. Next, incremental option expense. I'll not be writing again and again due to modification, because by this time you guys know number of employees will be exactly the same because it's the same company. Minus 35 minus 30 minus 29 into number of options per employee is also same. Only thing that will change is fair value of the option into vesting period completed is second year of the modification, this is okay, divided by total vesting period is also 2 minus last year also we have done modification expenditure na, right, and that is 20,22,750 that we need to reduce this year. Clear? Tell me how much it comes. Give me the number. 20,09,250. All right. What is the total then? 57,40,500 plus 20,09,250. 77,49,750. Are we done with this? Chalo, fantastic. We're done with all the calculations. Now let's go for journal entries. Did he ask you journal entries? No. Accounting he has asked. But your solution, he did not do anything. He has done just a calculation like this. He did not put any journal entries, but we'll do it. Okay. Your ICAI did not do anything. Okay. He has just done the calculation part over here. 58,37,250, 57,59,250, and 57,40,500. Okay. And modification first year obviously nil, second year 20,22,750, and third year 20,09,250. All these numbers we have also got, correct? Yes. But we are going to pass journal entries as well, just like a practice. Okay. So at the end of year 1, employee benefit expenses account debit to SBP reserve 58,37,250. That is the expenditure of first year, no modification whatsoever. At the end of year 2, okay, employee benefit expenses debit, eventually it will be transferred to P&L account to SBP reserve. What is the total? Both the normal one as well as the modification. This is the original plan plus modification. Put together 77,82,600. That much you will debit. Next, at the end of year 3, employee benefit expenses debit to SBP reserve. Again, the total, both the original plan as well as the modification. How much? 77,49,750. 77,49,750. That's it, Nana. Very simple. Chalo, finish it off. We'll move on to the next question. Are we done? All right. Shall we move to the next question? Give me confirmation. All right, guys. Let's move on to the next one. Okay. This question is based on modification and the next question is based on cancellation. Chalo. Anara Fertilizers Limited issued 2000 share options to its 10 directors for an exercise price of 100. Okay, how many share options? 2000. Exercise price is 100. The directors are required to stay with the company for next 3 years. Service condition. Face value of the option estimated 130. Okay. Expected number of directors to vest the option 8. During the year 2. So out of 10, 8 is expected to vest. Okay. During the end of year 2, there was a crisis in the company and management decided to cancel the scheme immediately. It was further estimated. Okay, it was estimated further as below. Fair value of the option at the time of cancellation 90. It has got dropped, which means the company isn't doing well. Market price of the share at the cancellation date was 99. Okay, this is totally irrelevant. Why? Because if you try to recollect the concept, did anywhere we talk about market price? No, we were always talking about fair value. That's why I said this is trap and irrelevant. I'll also take you back through the concept once so that you can revise. There was a compensation which was paid to directors and only 9 directors were currently in employment. At the time of cancellation of such scheme, it was agreed to pay an amount of 95 per option to each of these directors. Even though the fair value was 90, you are paying up and above the fair value. Why? Because you want to compensate, you want to make your employees happy. How many directors? 9 directors. Suggest how the cancellation will be recorded. Okay, I'll take you through the concept. So whenever there is a cancellation of ESOPs, for example, here the original vesting period is how many? 4 years. You're trying to cancel in between second year and third year, then accelerate the recognition of option expense, which means whatever, in this case, I think the cancellation is happening. Yeah. So whatever that you're going to recognize in the next year also, you prepone that and recognize in this year also, this year itself. Okay. That is the first step. Next, reversal or cancel the SBPR which is accumulated. So far you would have created SBP reserve, na? You debit that and take it to retained earnings. Okay. Normally, we'll take it to retained earnings only if all the vesting conditions are satisfied and if the employee chooses not to exercise the option. But I told you so many times that the standard is trying to avoid the company from manipulating, because some particular area suddenly company wants to increase the profit. Usually what it will do, it may cancel the option, and if you give the option to the company to reverse it, then it will cancel the ESOPs without any valid reason. It will manipulate the profits by reversing this, and then all of a sudden the profits will get increased. So therefore standard does not allow that. Therefore you need to take it to which? Retained earnings or general reserve. Okay. If there is no cash compensation paid, in that case, here itself you will stop. But cash compensation is paid to employees. In that case, what you will do, take the fair value on the cancellation date. Did we anyway talk about market price? No. That is the reason while reading the question, I told you that market price is irrelevant. Suppose fair value on the cancellation days is 220, which means we are talking about fair value only. Even though it is 220, we paid how much here? 250. In this question also, did we pay something extra? In that case, what we'll do, return earnings will debit. Why? Because already it has been transferred to return earnings. Now there is no SBP reserve. It is there in return earnings. So debit that. And employee compensation also you will debit, because you are paying something extra to whom? To employees. For what purpose? Because they provide services, for that purpose only you are giving. Therefore it comes under employee compensation or employee benefit expenses, which will eventually be transferred to P&L account, right? To bank, obviously. That much you are paying to them, na, cash compensation. I hope this is clear. Step 1, step 2 and step 3, if there is cash compensation. If there is no cash compensation, then step 1, step 2, that's all. Chalo. I have revised you the concept as well. Read the question. I'll give you 30 seconds. After that, you and me will solve it together. Nana, you have to put your pen on the paper and then solve it, Nana. Many students, they do mistake. They do, whenever they practice, they are thinking that they are very intelligent and then they try to do audit work. Have a calci, have the question bank or solutions book. Calci, chick, 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 chick. Okay, question 1 done, question 2 done. If you do like that on the exam, okay, you are saving time today, but on the examination day, you'll see the question, you know that, you know the answer, you'll feel that way. But when you put your pen on the paper, your pen will not move. It will be stuck like that. Trust me, this is what happens unless you are exceptional student in the entire world where you belong to 1%. Generally, we'll belong to 99%. So 99% it will not work. Chalo. 30 more seconds. After that, I'll start solving. You and me will do it together. Finished with your reading, Nana? All right. So let's start solving. Illustration 11. So this is based on cancellation. That cancellation happened in second year, correct? Which means first year we'll do usually. Okay. Chalo. So at the end of year 1. Cancellation happened in the second year. So first year we'll do it usually. So option expense per year 1 is equal to. What is the option expense for year 1, Ray? Same formula. Number of employees who are expected to exercise the option at the end of the vesting period, which is how much? 8 into 8 only, na, directors. Expected number of directors to vest the option. How much? 8. Chalo. Into. How many options? 2000 into. Pay value? 130 into. Vesting period completed 1 divided by total vesting period 3 minus expenditure recognized in the previous year 0. Can you guys give me how much is the number, Nana? Help me out with the number, guys. 6,93,333. Okay. Employee benefit expenses debit, which will eventually go to P&L account, to SBP reserve, which is how much? 6,93,333. 6,93,333. Okay. So now this is routine only, Nana. Nothing much over here, right? Everything else is there in the question. 2000 share options. Okay. And you have the fair value of the option, which is on the grant date, which is 130. Okay. Excise price is 100. Okay. Now what we have to do? We know that the option has been cancelled in the year 2, right? Let's write that, because you need to explain what has happened in the question. Chalo. So during year 2, the company has cancelled ESOPs and compensated the employees in cash. If there is no compensation, what we'll do, from SBP reserve, we'll transfer it to return earnings or general reserve. We'll stop there itself. But if there is compensation, then we'll go to the next step. We'll debit return earnings. We'll also debit cash if it is necessary when you're paying up and above the fair value on the cancellation date to bank. Sorry, we'll not be debiting cash. We'll be debiting employee compensation to bank or cash. Okay. Chalo. You'll do that only when you're paying your employee compensation up and above the fair value on the cancellation date. Okay. Chalo. Now, year 2. Once there is cancellation, what is the first step you have to do? Acceleration of recognizing option expense. What do you mean by acceleration of recognizing option expense? In other words, preponement. Preponement means what has to be recognized in the next year, we'll be doing that now itself. Okay, earlier we thought that the vesting period will be 3 years. But now, because you have cancelled your option in the second year itself, the vesting period no more is 3 years. It's gonna be 2 years only. Because in the second year itself, you have cancelled. Okay. In that case, what will be your option expense? You have to accelerate, which means usually the normal option expense of second year and the normal option expense of third year, because of cancellation, will be recognized in year 2 itself. Okay. So your number of employees will be how much? 9. Sir, why 9, sir? Look at the question. It's not 8. 8 was your expectation in year 1. 8 was your expectation in year 1. Now you have come to year 2. See here, this 8 is before during the year 2 sentence, which means this belongs to your expectation in year 1, before year 2. Once you have come to year 2, 9 directors were currently in employment. You understand the point? These are all the mistakes that students do, okay? Thinking that this is easy and all that, they'll do these kind of mistakes, okay? 9 into 200 options into 130 is the fair value of the option, right, on the grant date, into vesting period completed is 2, total vesting period is also 2. It is no more 3. You're preponing your expenditure recognition. Okay. Now 2 is the last year for you after this cancellation. Minus how much you have recognized in the previous year? 6,93,333. Give me the number, guys. Do the calculation and give me the number. 16,46,000. Huh? Okay. 16,46,667. All right. Chalo, this is your acceleration. So what's going to be entry rate? Employee benefit expenses debit to SBP reserve 16,46,667. 16,46,667. So why it is very high when compared to first year? Because this not just belongs to second year, it belongs to third year as well. So second year and third year put together, you're recognizing in the second year itself. That's what we call acceleration of recognizing option expense. Third year and second year, we're recognizing in second year itself. That's why it is more heavy, this number, when compared to this number. Okay, because this number belongs to only 1 year. This number belongs to 2 years. That is second year and third year. Clear? Hello? Right, fantastic. After acceleration, what we should do? We should cancel this SBP reserve and transfer everything that is there in SBP reserve to what, Nana? Retained earnings or general reserve. Okay, both are correct. Chalo, step 2, transfer from SBP reserve to retained earnings or general reserve. So I'll be using retained earnings over here. So SBP reserve debit, because already it is credit, to what, Nana? Retained earnings. How much? How much? 16,46,667 is the credit that you have done to SBP reserve in second year. In the first year, it is 6,93,333. Total credit was 20 lakhs. Sorry, 20 lakhs. Sorry. 16,46,667 plus 6,93,000. How much, Rana? 23 lakh 40. 23 lakh 40 is the credit. To that extent, you will debit. Alright, once we are done with this, we'll stop here if there is no cash compensation being paid to the employees. But now that you're paying, so you have to go for third step as well. Cash compensation. Okay, paid to employees. Cash compensation paid to employees. Okay, first let's calculate how much is total cash paid. Then we will write the entry. Don't write the entry first itself. Don't write the entry at the beginning only. First calculate how much is the cash paid. Based on this only, we'll have the entry. Total cash paid is how much? 9 directors. 9 directors. Into each director has got 2000 options. 2000 only na. 2000 or 200? 2000. Okay, into how much? 95. They are being paid cash. Look at the question. 95. Even though the fair value on the cancellation date was only 90, which means you are paying 5 extra. Okay, this is the total cash paid. How much it comes? 17,10,000. Now this is the total cash paid, correct? To the extent of fair value on cancellation date, you will debit retained earnings. For the balance, you will be debiting your P&L in the form of employee benefit expenses or employee compensation. Okay, right. So to the extent of fair value of option on cancellation date, retained earnings or general reserve will be debited. Okay, so what is fair value on the cancellation date, Ray? 9 directors into 2000 options per director into 90. So which is 16,20,000. To this extent, RE will be debited or general reserve will be debited. Now what about the balance? Excess amount paid. What will be debited, Ray? PL and P&L account will be debited through employee compensation or employee benefit expenses. Whichever word you want, you can write. How much is that difference? 90,000. 90,000 only, na? Yeah. Let's write the entry. I'll have the entry here itself. Retained earnings debit. Employee benefit expenses, which will be eventually transferred to P&L debit to bank. This will be 16,20,000, 90,000, 17,10,000. That's it. That's your entry. You can look at the concept over here. Okay. This is what we have done exactly. You can also write P&L in the place of employee compensation. Let us see what your ICAI has done. They did not write the entry. They just written amount transferred to P&L. That's all. 17 lakh 10,000 minus 16 lakh 20,000, 90,000. That's all. Only the calculations are done. He did not do any entry. That's okay. We have done the entry. We have done the calculations as well. We are much better. So directly he has written P&L. Chalo. Because if you directly debit P&L to the extent of 90,000, people will not understand for what you have debited. So you need to definitely write employee benefit expenses or employee compensation. And then through employee compensation, you debit the P&L. Then you will understand, okay, because of employee compensation, this has been debited. So this is the right one. There's no doubt in that. Okay. Chalo. Finish it off, guys. We'll move to the next one. Next illustration, we will see. Others finish it off. Give me confirmation. Till we have a lot of illustrations to solve. Done? All right, Nana. So now let's go to the next question. Illustration 12. Okay. Now this illustration 12 is based on the group concept. Okay. Let's have a look at it. A parent grants 200 share options to each of the 100 employees of its subsidiary. Parent grants options to the subsidiary. Now, let's get back to the concepts that we have studied. So shares ought to be issued by what? Parent company, correct? So this falls under scenario 1. In scenario 2, what happens? Services are received by the parent company, shares will be issued by subsidiary, but this falls under scenario 1. In scenario 1, when parent is issuing the shares to the subsidiary, we'll treat that as investment in subsidiary. 2, whoever is issuing shares, we will credit SBP reserve, right? If they are issuing shares now, we will be creating equity share capital. If they are issuing shares tomorrow, then today we'll create SBP reserve, and tomorrow from SBP reserve, we'll be creating what? Equity share capital and securities premium, right? And what the books of subsidiary will do, very simple. Services are received by the subsidiary. Whoever receives services, they will debit employee compensation or employee benefit expenses. And 2, because the parent is giving shares on behalf of the subsidiary, so you will write it as to capital contribution from the parent, correct? Parent will write investment in subsidiary. Usually this is the entry, employee compensation to SBP reserve, but it is divided between two organizations because one is receiving the service, the other is paying the shares or giving the shares, whatever it is. Got this? So I have revised you the relevant concept as well. So straight away, let's get solving. Let's get going and we'll solve this. Chalo, let's read the question. A parent grants 200 share options to each 100 employees of its subsidiary. Okay. What else? Conditional upon the completion of 2 years of service with the subsidiary. So service condition is there. The fair value of the share options on the grant date is 30. Okay. Generally on grant date, we'll not consider that. Okay, we will not consider it, but let's see in this question. At grant date, the subsidiary estimates that 80% of the employees will complete the 2-year service period. Okay, the estimate does not change during the vesting period. Very, very, very important point. I'll change the ink color. The estimate does not change during the vesting period means what is the importance of this sentence? It means that whatever the estimate that you have done on the grant date usually will not consider, okay, still holds good, which means the so-called estimate of fair value of 30 and subsidiary estimates that 80% of the employees will complete the 2-year service period, that is holding good. The estimate does not change during the vesting period, which means your grant date estimate is still holding good. At the end of the vesting period, 81 employees complete the required 2 years of the service. Okay, the parent does not require the subsidiary to pay for the shares, obviously, because parent is gonna pay, right? Pass the necessary journal entries for giving effect to the above arrangement. That is the question. You've got 30 seconds. Just read the question. Once you're done with your reading, we'll solve. But there is one problem over here. That question is not clear in whose books you need to pass the entries. Okay, in subsidiary or in exactly parent books or subsidiary books, which we don't know because the question is unclear. So we'll do both. I think your ICAI has done it in the books of the subsidiary, but that's okay. We'll do both. Chalo. Read the question, Anna. 20 seconds. We'll start. Shall we start? Okay. First, what we'll do, we'll pass the entries in subsidiary book. Then we'll do it in the parent company, in the books of the parent company. Right. Chalo. This is illustration. What is the number? 12. All right. First, in the books of subsidiary. For both the years we need to do, we'll start with year 1. You guys are ready? Okay. What will be our entry in the books of subsidiary? Yes. Whoever is receiving the services, they have to debit employee compensation or employee benefit expenses. Correct? So employee benefit expenses or employee compensation debit to capital contribution from parent. Correct? So we will write equity within brackets capital contribution from parent. Okay, right. Chalo, how much it comes? Let's have a look into the number. Employee compensation, how much, right? In year 1, employee compensation is equal to, which is nothing but your expenditure. How many employees you have got? Gross is 100 employees, na? Chalo. 100 employees. Year 1, what is the estimation, Anna? Whatever that is there on the grant date, that will hold good. Which is, at grant date, subsidy estimates that 80% of the employees will complete the 2-year service period. Which means into 80% into number of options per employee, 200 share options into fair value of the option on the grant date usually. Chalo, how much is that? 30. Right, into vesting period completed 1 year divided by total vesting period is only 2 years, correct? Minus expenditure recognized in the previous year is 0. So how much it comes? Solve it and give me the number, Nana. 100 into 80% into 200 into 30 into 1 by 2, obviously. Solve this and give me the number. Okay, 2,40,000. Let's put the 2,40,000 over here. 2,40,000 and 2,40,000. Okay, this is your year 1. Now coming on to year 2. Same stuff. I'll be copy pasting this and changing the number. All right. What about employee compensation expense is equal to? So how many employees we have got? Yeah, 100 employees. This is the gross number into, at the end of second year, it is 81%, correct? Now it has got changed into 200 options into 30 is the fair value, right? Into vesting period completed is 2 divided by total vesting period is also 2 minus expenditure recognized in the previous year is 2,40,000. That is equal to 81% only, na. It is clearly given, na, 81 employees, right? Which means 81% because total employees is 100. I just wanted to maintain that uniformity, okay? So therefore, I've written 81%, only to have uniformity in the answer. Out of 100, 81 employees means 81%. Clear? Hello? Alright, chalo, that's it. How much it comes, see? 2,46,000. Thanks, Nana. So which means the number will be 2,46,000 here and 2,46,000 over here. That's it. This is what in the books of subsidiary company. Now we have to do this in the books of parent company. Your ICAI has done it only in the books of subsidiary company, but your question has been silent. So for practice purpose, we'll do it in both. In examination also, if the question is silent, you better do it in both the books because we don't know what the ICAI answer is going to be. Okay, right. So year one. So what is the entry? Very simple. Whoever issues shares, first you credit to SBP reserve. Correct? How much is that for year one? 2,40,000. What you will debit? Investment in subsidiary. Very simple. 2,40,000. Clear? Next, year two. Whoever issues shares, you just credit SBP reserve. How much? 2,46,000. Just now we have done the calculation. Debit investment in subsidiary. Easy peasy. How much? 2,46,000. That's all. Finish it off. If you're done with this, we'll move on to the next sum. Finish it off, Nana. Alright guys, so with this we are done with all the illustrations, okay? So next what we'll do, we will go with the remaining questions from your ICAI, okay? So this is question 1. So let's have a look into this question. I think first 3-4 questions are really basic, Nana. After that we'll get into some decent sums. An entity issued 100 shares, okay, to each of its 1000 employees, subject to the service condition of next 2 years. Okay, they have to stay in employment for 2 years. Okay. Grant date, fair value of the share is 195. Fair value on the grant date is okay 195. Then there is an expectation that 97% of the employees will remain in service at the end of first year. Okay. However, at the end of second year, the expected employees to remain in service would be 91% of the total employees. Calculate the expenses for years 1 and 2. Very basic question, Anna. Actually, I can ask you guys to do this on your own, but anyway, we'll do it fatafat. Ready? Question number 1. See, for students who are live, you don't have a choice. You have to do along with me. But to the guys, to the students who are going to watch these videos in future through video classes, you have the option. You can just pause the video right now and try to do it on your own. Okay? That's the only way you'll practice, Nana. Chalo. But it's my job to do everything. So I'm going to do almost all the sums. Right. So year 1 and what's going to happen? Total employees is 1000. All right. In that 97%. Okay. Number of employees at the end of first year is 1000. In that, how many are expected? 97%. So number of employees into number of options per employee or shares per employee 100 into fair value of the option on the grant date. How much is that? 195 into vesting period completed is 1 divided by total vesting period is 2. How much will be your option expense, Ray? Expense. In this case, it is shares. Give me the number, Ray. I'll only do myself. Into 100 into 195. How much, Nana? Right, 94,57,500. All of you got the same? Simple. Next, year 2 end. Expenditure is equal to how much, guys? 1000 into 91%. Okay. Into 100 into 195 into 2 by 2. minus expenditure recognized in the previous year, which is 94,57,500. Correct? Let's do the calculation. 1000 into 91% into 100 into 195 minus 94,57,500. 82,87,500. That's it. Simple and straightforward question. We should not be taking too much time, Ray. We have done so many sums so far. Fatafat, this should be done. Are we done with this? Chalo. Next, we'll go to question 2. Okay, this is done. Quite simple and straightforward. Come to question 2. An entity issued, okay, shares. How many? 50. Okay. With each of its 170 employees subject to service condition of the next 2 years. Okay, the settlement is to be made in cash. Right? Grant date, fair value of the share is 85. Okay. Our fair value at the end of first year, second year were 80 and 90. Why first year and second year fair values are given? Because this is a SAR. Obviously, you have to keep on remeasuring it. Calculate the expenses for year 1 and year 2. Simple. Can you guys do it? Okay, we'll start doing it. What is there? Question 2. So this question is based on SAR. Chalo, at year 1 end. So what is the calculation of the option expense? Very simple. 170 employees. Okay, 170 employees. How many of them are expected? Okay, settlement is to be made in cash. Nothing is given. So 170 employees, like that only will take into 50 shares per employee into, this is year 1 end. So fair value at the year end. Fair value at the year end is how much? 80. Year 1 end it is 80 into vesting period completed is 1 divided by total vesting period is 2. That's it. Pretty simple. So 170 into 50 into 80. 3,40,000. Chala, moving on to year 2 end. At year 2 end. Option expense is equal to, how much, Nana? 170 employees into 50 options into fair value at the end of year 2, 90 into vesting period completed is 2 divided by 2. Correct? Minus expenditure recognized in the previous year is 3,40,000. So this will be 170 into 50 into 90 minus 3,40,000. 4,25,000. That's it. That's it. Finish it off. Finish it off, guys. We'll move on to question number 3. Very basic questions, okay? Shall we move on? Right? Chalo. Okay, this is also done. Next, question number 3. Okay, this is a basic question based on group concept. Company P is holding company for company B. Okay, a group share based payment is being organized in which parent issues its own equity shares. If parent is issuing equity shares, what you will do in the parent books? To SBP reserve. For the employees of company B, the details are as follows. Okay, what is that? Number of employees of company B is 100. Grant date, fair value of the share 87. Number of shares to each employee granted. Okay, directly shares is given. So when shares are given, what you will do? 2 equity share capital. You will not be writing 2 SBP reserve. You will write 2 SBP reserve when in future you are going to give shares, but today you have to create a reserve. Okay, you are giving an option, but that's not the case. Directly shares are given, therefore you will write 2 equity share capital instead of writing 2 SBP reserve. Next, vesting conditions immediately. It is vested immediately. So shares are also given immediately, which means you will write 2 equity share capital, 2 securities premium. Chalo, pass the journal entry in the books of P and B. Okay, so P is nothing but holding company, so that is the parent, and B is subsidiary. Easy peasy. Shall we do it? So we should not be writing 2 SBP reserve, okay? We should be writing what? 2 equity share capital. Question number 3. In the books of P, within brackets I'll write parent or holding company. Parent or holding company. Ready? Yeah. So investment in subsidiary, that is what you will debit, correct? Company B. 2. Equity share capital or securities premium. Normally we'll be writing to SBP reserve, but here we can't do that because shares are already issued and we don't know how much is the face value, how much is the securities premium. Therefore, we'll combine that and we'll write to equity share capital slash securities premium. How much is that? Here itself we'll do the calculation. 100 employees into number of shares to each employee 25 into fair value of the share on the grant date 87. That's it. Into 1 by 2, 2 by 2, all those things are not there because it is vested immediately. So how much will be getting the number? 2,17,500. That's it. 2,17,500. Are we done? Chalo. Next, in the books of company B. Subsidiary. Because subsidiary is receiving services, you have to debit employee compensation, correct? So employee compensation or employee benefit expenses or expense, whatever it is, debit, eventually it will go to P&L account. 2, you are getting the money from the, exactly, capital contribution from parent, from the parent. Same amount, 2,17,500. 2,17,500. Easy peasy. Are we done? Alright guys, chalo. I think we are done with all the basic sums. Next sum, is it a good sum? Decent kind of a sum. Question number 4. Phi is also average. Okay. Chalo. We'll stop the session here. We'll take a break. And after that, we'll continue with question number 4. And we'll move on. Okay. Small break. Chalo.